Welcome back to Old Men, New Money. I'm Douglas Borthwick, and today we're talking about infrastructure. I know. Infrastructure sounds boring. Everyone wants to talk about the hot new token offering or the latest blockchain innovation. But you know what determines whether digital securities actually work? The infrastructure. The alternative trading systems where they trade, the transfer agents who maintain the cap tables, the custodians who hold the assets. This is the plumbing of the digital securities market. And here's the thing about plumbing. When it works, nobody notices. When it breaks, everything stops. I learned this lesson the hard way at INX. We realized early that if we wanted digital securities to succeed, we couldn't rely on infrastructure that didn't exist yet. So we built it. We acquired Open Finance, which gave us both a broker-dealer and an ATS. And we acquired Tokensoft's transfer agent. We built our own trading platform. We became the infrastructure. Here's your 30-second version. Digital securities need three critical infrastructure components working together. Alternative trading systems provide regulated venues for secondary trading. Transfer agents maintain accurate ownership records and ensure compliant transfers. Custodians securely hold the digital assets for institutional investors. Without all three working properly, the market doesn't function. We're in this phase where there's more demand for digital securities infrastructure than supply. Companies are tokenizing assets, but there aren't enough regulated trading venues. Investors want to buy, but there aren't enough custody solutions that they trust. This is the bottleneck. This is what's preventing digital securities from going mainstream, not the technology, not the regulation, but the infrastructure. Now, when I was trading FX at Merrill Lynch and Morgan Stanley, we had sophisticated technology. Our trading algorithms, risk management systems, client portals, but you know what determined whether we could actually do business? The infrastructure. CLS Bank for FX settlement, SWIFT for messaging, DTC for securities custody. When infrastructure works, you don't think about it. When it fails, billions of dollars get stuck. Think of digital securities infrastructure as a three-layer stack. Layer one is custody, the foundation, securely holding the actual digital assets. If you can't custody tokens safely, nothing else matters. Layer two is transfer agent services, the record-keeping layer, maintaining accurate ownership records, ensuring transfers comply with regulations, updating cap tables in real time. Layer three is the trading venue, where secondary market transactions happen. Buyers and sellers finding each other, price discovery, liquidity provision. Each layer has different requirements, different regulations, different players. Let's dive into each using examples from my actual experience. Custody assets for digital securities is fundamentally different than custody for traditional securities. With traditional securities, custody means the depository trust company or a sub-custodian holds securities in book entry form. They maintain the records. You don't have physical certificates. With digital securities, custody means controlling the private keys that control the tokens. Whoever controls the private keys controls the assets. But here's the critical difference from pure cryptocurrencies. With security tokens, if you lose your keys, you don't lose everything forever, because there's a transfer agent maintaining legal ownership records. The issuer can freeze the old tokens and reissue new ones to your new wallet address. This is a huge advantage. You get blockchain benefits with traditional securities protections. There are three custody models. Self-custody means the investor holds their own private keys. This is the not your keys, not your coins approach. Maximum control, maximum responsibility. But unlike cryptocurrencies, if you lose your keys to security tokens, the transfer agent can help you recover by freezing old tokens and reissuing new ones. This protection doesn't exist with Bitcoin or Ethereum. For retail investors who understand technology, self-custody can work. For institutions, almost never. Banks, insurance companies, pension funds can't use self-custody. Regulators won't allow it. Third-party custody means a regulated custodian holds the private keys on behalf of investors. This is what institutional investors require. They need regulatory compliance, insurance coverage for lost or stolen assets, recovery procedures if something goes wrong, segregated accounts, and proper accounting. Multi-signature custody is a hybrid. Multiple parties must approve any transaction. For example, 2 of 3 multi-sig requires 2 out of 3 designated parties to sign off on any transfer. This is common for high-value accounts or corporate treasuries. Let me talk about who actually provides custody based on what I've seen in the market. Anchorage Digital is one of the first federally chartered digital asset banks. They provide qualified custody for institutions. Full insurance coverage, regulatory compliance, they custody a wide range of digital assets, including security tokens, and major institutions trust them. Coinbase Custody is part of Coinbase, but a separate entity with separate insurance and compliance. They custody over $130 billion in digital assets. They support security tokens on Ethereum, Polygon, and other chains. BitGo focuses on institutional custody with multi-signature wallets. They provide custody for security tokens and have insurance coverage through Lloyd's of London. Fireblocks provides infrastructure that many platforms use on the back end. At INX, we evaluated multiple custody solutions for our platform. Traditional custodians like BNY Mellon, State Street, and Northern Trust have all announced digital asset custody services. Implementation has been slow, but they're coming. The cost of custody is significant. Institutional custody typically costs 0.5 to 2% of assets under custody annually, with minimums of $50,000 to $100,000 per year. This is much more expensive than traditional securities custody, which is often under 0.1%. The premium reflects complexity and risk. Transfer agents are the unsung heroes. They maintain the official record of who owns what. At INX, we acquired Tokensoft's transfer agent specifically because we needed a transfer agent that understood both traditional securities and blockchain. This was critical to our business model. For public companies, the transfer agent is the single source of truth for the cap table. They handle recording ownership changes, processing corporate actions like dividends and splits, issuing certificates when applicable, ensuring compliance with securities laws, and communicating with shareholders. For digital securities, transfer agents do all that plus integrate with blockchain systems, enforce smart contract transfer restrictions, manage wallet addresses as identifiers, handle lost key recovery procedures where they can freeze old tokens and reissue to new addresses, bridge traditional and digital record keeping. Tokensoft's transfer agent, which we acquired at INX, was one of the first traditional transfer agents to embrace digital securities. They understood both worlds. They worked on multiple high-profile security token offerings. Colonial Stock Transfer is another traditional transfer agent that moved into digital securities. They've handled several significant offerings. Securities acts as both platform and transfer agent. They maintain cap tables for tokens issued on their platform. This vertical integration gives them control over the entire process. Broadridge is a major player in traditional securities infrastructure. When they fully commit to digital securities, it'll be a game changer because of their scale. Here's what makes digital securities transfer agents unique. They maintain 2 sets of records: the blockchain ledger, which is the on-chain record of token ownership, and their traditional cap table, which is the legal record that ties blockchain addresses to actual investor identities. These 2 records must match. If they don't, you have serious problems. Legal ownership becomes unclear, regulatory compliance fails. It's an absolute nightmare. But this dual record system provides a critical advantage. If an investor loses their private keys, the transfer agent knows who legally owns those securities. The issuer can freeze the lost tokens on-chain and reissue new ones to the investor's new wallet address. Try doing that with Bitcoin. You can't. With security tokens, you get blockchain innovation with investor protection. At INX, we built systems to ensure these records stayed synchronized. Every on-chain transfer triggered an update to the legal cap table. Every cap table change was reflected on-chain. This synchronization was critical. The transfer agent also manages the compliance layer. Before any transfer happens on-chain, the transfer agent systems verify whether the recipient is accredited if required, whether the holding period has expired, whether there are volume restrictions on transfers, whether the transfer is to an authorized jurisdiction. Only if all checks pass does the transfer agent authorize the on-chain transfer. This is programmatic compliance, and it's revolutionary. Now we get to trading venues. An alternative trading system is a non-exchange trading venue that matches buyers and sellers. They're regulated by the SEC under regulation ATS. For digital securities, ATSs are critical because most security tokens can't trade on traditional exchanges like NASDAQ or the New York Stock Exchange. They need specialized venues that can handle blockchain-based securities, integrate with digital custody, enforce transfer restrictions in real time, provide price discovery for illiquid assets. Let me talk about the players I know firsthand. INX operates as both an ATS and as a broker-dealer. They trade INX tokens plus a growing list of other digital securities. When I was there, we raised $85 million through our own offering, then built the infrastructure for others. They're international, operating in multiple jurisdictions. Recently, they listed tokenized equities from Backed Finance. Now you can trade fractional shares of Apple, Microsoft, Google, and others 24 hours a day, 7 days a week. T0 launched in 2019 as a fully regulated ATS for digital securities. They've faced challenges with volume and liquidity, as we all have, but they're still operating. They've got several securities listed. Patrick Byrne, who is Overstock's founder, pioneered this space. Securities Markets is part of the Securities ecosystem. They provide secondary trading for securities issued on the Securities platform. It's more of a closed-loop system, but it works for their clients. BlackRock's BUIDL token, with over $500 million, trades through this infrastructure. An Open Finance network, which INX acquired, was one of the earliest digital securities trading platforms, focusing on the 24/7 trading with partnerships with traditional broker-dealers. But here's the harsh reality. Most digital securities ATSs are extremely illiquid. You can have the best technology, the cleanest regulatory setup, the most user-friendly interface, but if there are no buyers and sellers, there's no market. And this is the chicken and egg problem. Issuers don't want to tokenize if there's no secondary market. And investors don't want to buy if they can't sell later. ATSs can't build liquidity without both issuers and investors. At INX, we saw this daily. Some stats to put this in perspective. Average daily volume across digital securities ATSs is often under $1 million total. Compare that to NASDAQ's over $100 billion in daily volume. The number of actively traded digital securities is fewer than 100. Bid-ask spreads on illiquid tokens are often 10 to 30%. This is brutal for investors. We're solving this, though, through multiple approaches. Market makers who provide continuous bid and ask quotes. This tightens spreads and provides base-level liquidity. And so we'll see if market makers become more active. Interoperability between ATSs is needed so liquidity is aggregated. If someone lists on one platform, they're discoverable on others. And this is still being built out. Institutional onboarding. If large institutions start trading digital securities, they bring meaningful volume. And this is the holy grail. And we're beginning to see early movement here. As I said earlier, ATSs are regulated under Regulation ATS, which has several requirements. You must file Form ATS with the SEC and become a member of FINRA. You must maintain fair access to the system. You must ensure transaction integrity. You must safeguard confidential information. You must maintain adequate capacity. If an ATS trades 5% or more of the volume in a security, it must publicly display its best bids and offers. You're subject to SEC and FINRA examinations. They come in, they review your systems, your compliance, your operations. At INX, we went through multiple examinations. We built systems specifically to pass regulatory scrutiny. This is expensive and time-consuming, but it's the cost of being a regulated marketplace. For digital securities ATSs, there are additional considerations. How do you handle 24/7 trading when traditional markets are only open 9:30 to 4? How do you integrate blockchain settlement with traditional securities settlement systems? How do you handle cross-border transactions? These questions are being answered in real time by companies like INX. Now, the US is not the only game in town, and frankly, the US is falling behind. Switzerland's sixth digital exchange launched in 2021. They offer fully regulated digital securities trading, settlement, and custody infrastructure. They've issued digital bonds and are expanding to equities. They're way ahead of us. Singapore's monetary authority has approved multiple digital securities platforms. Singapore is positioning itself as the Asian hub for digital assets trading. They're moving faster than US regulators. The UAE, specifically Dubai and Abu Dhabi, have created special economic zones with digital asset-friendly regulations. Several digital securities exchanges have launched there. They're attracting issuers and investors. The EU's MiCA regulation provides a framework for digital securities across all EU member states. Platforms are launching to take advantage of this harmonized approach. The US is actually behind the curve. Our fragmented state-by-state regulation and cautious SEC approach have slowed infrastructure development. This frustrates me because we could be leading instead of following. I need to mention one more critical piece, the broker-dealer layer. Even if you have an ATS, investors typically need to go through a registered broker-dealer to trade. The broker-dealer verifies investment accreditation, handles KYC and AML, places orders on the ATS, and manages custody and settlement. At INX, having your own broker-dealer is essential. We could offer a complete experience. For companies without their own broker-dealer, they need partnerships with traditional broker-dealers. This adds costs and friction, but it's required under current regulations. Let's look at digital securities infrastructure in 2024 and 2025. Registered digital securities ATSs in the US, there's 6 active platforms. Average daily volume across all, $2 to $3 million total. Number of unique securities traded, 83. Largest single day volume, $14 million. Total digital securities under custody, estimated $4 to $5 billion. Number of institutional grade custody providers, 12 active providers. Average custody cost, 1.2% of AUM annually. Transfer agents actively handling digital securities, 15 qualified agents. Largest digital cap table, over 9,000 token holders, that's INX. Average cap table size, 250 token holders. These numbers are small compared to traditional markets, but growing fast. 2024 saw 40% growth in infrastructure capacity. We're building momentum. Infrastructure can fail in multiple ways, and I've seen most of them. Custody failures happen. Keys get lost, stolen, or compromised. Insurance kicks in, but it's a nightmare. This has happened with smaller custodians, and it's why you need Tier 1 providers. Transfer agent errors are serious. Cap table records don't match blockchain records. Legal ownership becomes unclear. This takes months to resolve and costs a fortune in legal fees. ATS outages kill confidence. Trading platform goes down during critical market developments. Investors can't sell, lawsuits follow. At INX, we built redundant systems specifically to avoid this. Settlement failures create chaos. Buyer sends money, seller sends token, but something breaks mid-transaction. Who bears the risk? How do you unwind? You need clear protocols. Regulatory shutdowns are existential. SEC or FINRA determines an ATS or custodian is non-compliant and shuts them down. Token holders scramble to move assets. This has happened to platforms that didn't take compliance seriously. Good infrastructure providers have redundancy, insurance, and recovery procedures. And at INX, we spent millions building resilient systems, because infrastructure failure destroys trust. Now, here's what I think happens over the next 2 to 5 years. Consolidation is inevitable. We've got too many small ATSs with no liquidity. They'll merge or shut down. 3 to 4 major players will emerge. INX with Republic, Securities, and maybe 1 or 2 others will dominate. Traditional exchanges will enter. NASDAQ, New York Stock Exchange, or CME will launch digital securities trading. When they do, it'll be a watershed moment. The credibility and liquidity they bring will transform the market. Custody costs will drop as technology improves and competition increases. We'll see 0.2 to 0.5% instead of 1 to 2%. This will make digital securities more attractive. Interoperability standards will emerge. The industry will adopt common protocols for how systems talk to each other. This will enable better liquidity aggregation across platforms. Institutional adoption will accelerate. Once a few major pension funds or endowments use digital securities infrastructure successfully, others will follow quickly. The herd mentality works in our favor here. What should you do right now? If you're an issuer, research transfer agents. Talk to 3 different ones. At INX, we brought ours in-house, but most companies need external partners. Understand their technology and compliance capabilities. Plan for liquidity before you issue tokens. Know where they'll trade. Establish relationships with ATSs. At INX, we solved this by being the platform, but other companies need partnerships. Choose custody providers carefully. Identify which custodians you'll recommend to investors. Institutional investors will ask before they invest. Have good answers. Understand the full cost structure. Factor in ongoing transfer agent fees, ATS listing fees, market maker costs. These are real expenses that continue after you raise capital. If you're an investor, open accounts on digital securities ATSs. INX, Securities Markets, T0, others. Even if you don't trade immediately, get familiar with how they work. The user experience varies significantly. Research custody options. If you're holding significant value, self-custody might not be appropriate. Understand your options before you invest. Evaluate liquidity before you invest. Check actual trading volume, not promised volume. At INX, we published all of our trading data. Transparency matters. Can you exit if you need to? Monitor infrastructure providers. Follow news about ATSs, custodians, transfer agents. Their health directly affects your investments. If your trading platform is struggling, your liquidity suffers. Infrastructure isn't as exciting as talking about the next big token offering or revolutionary blockchain protocol. I get it. But here's the truth. The companies and platforms that build the best infrastructure are the ones that will win. The picks and shovels of the gold rush make more consistent money than the prospectors. At INX, we understood this from day one, and that's why we acquired Open Finance, bringing in both broker-dealer and ATS capabilities. That's also why we acquired Tokensoft's transfer agent, and that's why we built a trading platform. We became the infrastructure because we knew that's where lasting value is created. If you're building in digital securities, focus on infrastructure. Partner with the best transfer agents, custodians, and trading venues. Don't cut corners. The companies that scrimp on infrastructure are the ones that will fail when they scale. If you're investing in digital securities, evaluate the infrastructure. Ask who's the transfer agent. Where does this trade? What custody options exist? If the answers aren't solid, that's a red flag. Walk away. This has been Module 1 of Old Men, New Money. We've covered the foundations, what digital securities are, the regulatory framework, how STOs work, and the infrastructure layer. I hope these 4 episodes gave you a comprehensive understanding of digital securities, not just the hype, but the reality, the opportunities and the challenges, the successes and the failures. This is a market that I've helped build. At INX, I helped raise $85 million in the first SEC-registered digital security offering. I helped acquire Open Finance for broker-dealer and ATS capabilities, and acquired Tokensoft's transfer agent for transfer agent services. There, we built infrastructure that's now used across the industry. I've lived this. And I can tell you with certainty, digital securities are the future of capital markets, not because of blockchain hype, because they solve real problems: faster settlement, lower costs, global access, fractional ownership, 24/7 trading. The infrastructure is being built. The regulations are being clarified. The market's growing. This is happening. The question is whether you're part of it. I'm Douglas Borthwick. This is Old Men, New Money. If these 4 episodes helped you understand digital securities, share them with someone who needs this knowledge. That's how we build this industry. Education, one person at a time. In the next module, we're diving into corporate treasury strategies, MicroStrategy's Bitcoin playbook, Ethereum treasury companies, Solana validators, the companies turning crypto holdings into shareholder value. Until then, stay curious, keep learning, and remember, in this game, experience matters.